You're watching Dukascopy TV. I'm Darren McDermott. Well, the topic for discussion on today's show is emerging market bond yields, as they are the fastest growing of asset classes. I have Daniel Tassan-Din, Head of Asset Management and Fixed Income at Leumi Bank, in the studio. Welcome, Daniel.
Thank you.
So tell us, what have been the main driving factors for this rapid growth?
Basically two factors. The first one is the effect of globalization. This has brought a lot of the emerging markets countries, and if you can look at the graph, you can see there that everything in the world except maybe Africa has been integrated into the world economy. And what this has done is has brought much more transparency, better governance to a lot of these companies. And the second factor is that we have returns, annualized returns in the 8 to 10% that are very competitive to equity return historically. And this has brought a lot of investors from the pension funds and individual investors.
And how can they provide a similar return to that of equity, but of course with much lower volatility?
Yeah, in fact, if you look at the graph over the last 15 years, this asset class and the high yield in general, not only emerging market, but the general high yield corporate bonds have been returning 8 to 10%. And if you look at the volatility, is almost half. Why is this? Mostly because a lot of these emerging market companies are new, they were not known. You have a lot of still premium to be paid for the countries in which they're coming from. There are some political risk potentially, but a lot of this is being diminished, and more investors are buying the securities, and therefore the yield is coming down and prices are going up.
And Daniel, how does improving credit actually drive returns?
Basically, as you know, bonds, if risk in bonds is coming down, then price is moving up. And if you look at the table there, you can see that the average ratings for this asset class has been moving from a double B plus expected to be triple B plus. So this improvement in ratings, it's reducing the risk and then increasing the prices, and therefore the total returns of this asset class.
And of course, risk. So tell us about the risk involved.
Sure. As we are talking about bonds, there are usually two risks. The first one is interest rate risk, and the second one is credit risk. Mm-hmm. The interest rate risk, probably for this asset class, is the least important, because the yield that they're offering you usually absorb and offset any potential increase in interest rates. So vis-a-vis a government bond, high yield bonds has much less interest rate risk. Of course, has default risk, credit risk, and this can be minimized by diversification. If you have a very highly diversified portfolio, then you are much less exposed to any negative impact of credit risk. And as we said before, the ratings is improving, the credit risk is declining, and this certainly is a positive.
Daniel, thank you very much.
My pleasure.
And thank you for watching Dukascopy TV. Now, coming up next, we will be discussing the cinema sector. So, if you like movies, don't go anywhere. See you soon.